Welcome back to the channel. And in today's video, we have brought you a good one. So we'll be talking about financial planning, simplified interest, investment, and diversification explained. So the objectives will be the difference between simple and compound interest, effective budgeting strategies, and common finance models. Another objective will multiple ways to generate income and grow wealth. Why diversification matters in your investment portfolio, how to access risk tolerance and align with your financial goals. Another thing that we look at is the what special funds are and how they can offer higher returns. So whether you are new to the finance or you are an expert, you can uh, get something that can help you along the way. We're all in the journey of our finance. Yeah, and in today's we have a good presenter and good tips on finances. So thank you.
So I'll start with a very simple thing. It might look simple, but it is very powerful. And this is all about what we refer to as a compounding. And sorry. So compounding is it comes from the word compound, making things many. And one of the quotes I've put there is from that guy. He's one of the best people if you want to quote about investing, and he said that compounding is like an eighth wonder of the world. And the reason is that what you want to have is time and money. So if this is all about, this is investment. You're just looking at your time over a period of, your money over a period of time and what it is able to do to you. So if you do just a simple, saving, this is the kind of trajectory that you're expected to have. But if you bring in the aspect of compounding, this is the kind of trajectory that someone proposes that you're going to have. And I'm going to be having, quotes and pictures just to try and illustrate this. So this is, I took this from Twitter or X, for those who call it X. And this is just a simple illustration of what compound is all about. And this is an example of, if, let's say, this is hypothetical, you are 35 years now, you can insert your age, but this is just for, example. If you save 5,000 over a period of up to when you retire, that is 35 years, it means by the end of those 35 years, if you're able to save your money or invest in a vehicle that was giving you an average return of 9% per annum, it means by the time you retire, you're going to have about 14.7 million. And if you double that investment or that saving to 10,000 per month, it means then you're going to have double that amount. And there are many ways of how you can calculate this, but what I'm showing down there is the formula. If you remember when we were in school, for those who did some of those old systems, I don't know whether this is still in school, we used to do compounding interest. And this is a formula. So it shows you, how much you're starting with, how long you want to invest it for, the kind of interest rates that you are getting. So I want us just to do a simple. So there's a link there to a calculator. You can get this online. So I just want us to be able to demonstrate whether, it can't work. Oh, okay. Just a minute, let it load. So we are saying this is just one of the many calculators that are out there. And what we are saying is that if you put any currency here, for us, let us just put other currency, where I think our Kenyan currency will be there. And let's say you're just starting with nothing, okay? So you want to start now. So you don't have anything, you want to start now. And you're saying that if you put this in an investment that is giving you 9% per annum, so you go yearly, and then you want to do this for, we are assuming you are 25 years, so you do this for 35 years until you retire, and you can decide whether you want to include all the days of the week or not. There are those places that give you returns even all days. There are those that only give you during weekdays, and the rest you can decide which one you go to go for. And you're saying that each and every month you make 5,000 deposit, and that's it. You just be making a 5K deposit each and every month, and let's say you're starting today, and you calculate. So according to this, it's going to give you 13. Oh, I put 34. Sorry, 35. 35 years. So according to this, it's going to give you a return of 14.8 million for that period. And the amount of money you as an individual have contributed, the 5K deposits you will have done for those 35 years is 2.1 M. All right. And you can change the numbers here depending on however you want to do it. For example, you can say right now, maybe I'm starting with, maybe I have 100K somewhere. Let's say, for example, previously, last year when you talked about the money markets, maybe you had some 100K, by now you have accumulated, and now you're asking, where do I put this? So if, for example, let's say you have that and that is what you're starting with, but now you'll be doing 5K every month, it means by the end of that time, you will have about 17.2 million. So let's come back here. It means by the end of that period, as you have seen, you'll have about 14.7. But if you are just putting that money in a place where you don't earn any interest, it means you'll have 2.1 M. So do you see the difference between just putting somewhere, saving without any form of interest that you're earning, and whereby you are earning some compounding? So that is the difference, the simple difference between compounding interest and just simple interest. Tuko pamoja hapo? Thank you. So let's just go back to baseline. I think you have heard this so much that you have read and people tell you, oh, save maybe this percent, use this percent. So basically, this is just trying to tell you that whatever income that you get, there's that amount that you have to use, because maybe you have to eat, because you have to travel, you have fees to pay, all those things. So there are those who say 50, 40, 10. There are those who say 50, 20, 30. There are even those who say 60, 30, 10, all those different formulas. And the reason why you are having all this is because by the end of the day, you want to be able to whatever that remains, you want to be able to put somewhere so that you earn some income. And the ways you can do this is from different ways. For example, if you decide to go for shares, stocks from companies, we shall see what that is. You can earn what we call dividends or even capital gains, or you can earn interest, what you have just calculated right now. Or you can even go to, rental income, those who build houses for, for people to live in. Or let's say if you have some level of expertise, then you're in a certain board, then they give you some allowances. So all that. And the reason why we are doing all this is because all of us, we want to be on this side of this, diagram, whereby all your investments are able to give you enough income, and so that you even have surplus. And if you are able to have surplus, you're able to cover all your income, all your requirements, financial requirements each and every month, for example, then you say you have what we call financial freedom. But if you are falling so much on this other side, then it means it's something that you need to do, because it means you always be dependent on, for example, maybe your job, or maybe the little income that you get elsewhere. All of us, we want to be on this side, so that at least you can decide when to do A, B, C, D. Maybe not someone deciding for you. And you might ask me, but last time or last year when you were here, you said that, put money in money markets. Money markets is the way to go. But when you look at what is happening, so I just took this from maybe last month or 2 months prior. For example, you can see from the various people who offer money markets, you can see the rates are quite low. Others are even so low, they can even give you some heart attack. But the question you're asking is that, so what do we do? Okay, and you might even try to ask to tell me, did I lie to you? No, of course I didn't lie to you, because at that time, and once the thing that you need to understand is that if somebody is telling you they are taking your money and they are going to give you a return, it means that person has to invest somewhere so that they're able to give you that return. So you find that majority of money market funds, they invest their money in what we call government securities, and specifically treasury bills. And this, if you are in this financial, area, you remember that when the current government came into power, there were empty coffers. So they needed a lot of money. And if there's high demand for money, it means the interest rates go up because they need a lot of money. So they were even borrowing at high rates so that they can quench the empty coffers. And if you compare between January and December of last year, you find that the rates were between, up to 11%, for example. Even the prior year, they were even up to around 16%. But by the time we were getting to December, they were around 7. The best you can get is like a 9% from the treasury bills. So this one leaves you wondering, so what do we do, or what do we do next? So it means there's some good news. There's some light at the end of the tunnel, some horizon or at the horizon, and there's something that we can do. And one of the things that I can advocate is what we call portfolio diversification. So this one looks like a very big term. So I took the liberty of just going online using Microsoft Copilot just to search what portfolio diversification means. So this is whereby the simple thing that you have been saying for a long time, don't put all your eggs in one basket. That is what it simply means. Just spread them so that even if you trip and fall with one of the baskets, the others will be okay. So this means it is a strategy whereby you spread your investment in different asset classes or in different areas of investments, so that if one area dips in terms of returns and then another area does very well, the one that does very well is able to cover the one that dips. For example, you can go for stocks. You can go stocks, it's the same as shares and all that. You can go for bonds. You can go for all these other that you hear people talking about. So you can spread your money around areas that maybe are high risk. Or for example, maybe high risk is, for example, maybe currency trading, or you can even go to those that are risk-free, or you can just call them risk-free or low risk, or even medium risk. So bonds, stocks, and the rest. And maybe your portfolio could look like something like this, whereby you can go for, properties or like gold. You can do real estate, shares. You even have maybe money, cash in bank, and all that. And how you do this is dependent on so many things. And one of the most important thing is for you to consider your timelines and goals. What is it that you want to do? Or what is it that you want to achieve? And how long do you have to achieve that? For example, if you want to buy a house that is worth 5 million, for example. So how long are you giving yourself to be able to get that 5 million? So that one, we now remember the first slide we had, it was about time and money. So how long will tell you the kind of investment vehicle that you want to go with. Then the other thing is very important. Know your risk tolerance, or how much you can tolerate loss, financial loss. Are you the kind of person, if you lose 1,000, then you say, I'm done, I will never do this kind of thing again? Or are you willing to lose, let's say, even up to 20 or 25% of your investment, and you're still there. So know how much you can tolerate or how much you can lose, so that you are able to know what kind of investment to go for. The other thing is that you can, what you are saying, you can spread, you can diversify, you can spread your money or your investment across several areas, as you have been saying. And then if something is not working, if you're in one area and you see, for example, right now you're saying money markets are around 6, 7%, 8%, and you have your money there. So, I mean, you don't have to stay there. Look for something else that is doing well at the moment and then relocate. So being able to shift between investments as time goes on and as things change. And again, you find that depending on where you go, make sure that you're looking for investments that in a way complement each other. And so, under this, there are so many such areas that you can focus on. But for today, I want us to look at these three. They're not in any order, it's just listing them there. So I know this is not relatively new information. People have heard about it, or maybe as you go by, you have heard somebody say something about special funds. So what are these special funds and why are they called special? So remember, for example, money market, they put your money, for example, in treasury bills, and they, basically they're supposed to put your investment in a time that doesn't exceed 18 months, for example. But what if you want to do more than that? So special funds is one area that has been regulated by Capital Markets Authority. And what happens is that they are able to diversify. They are able to go for more different type of investments compared to the normal kind of investments that are done, for example, in money markets. So, and because of being able to go for different vehicles or areas of investment, they are able to give you higher returns. Higher returns because I told you, if one dips, then there is one that is performing very well, and you see by the end of the day, then it is able to cover that, and you're able to get something out of it. So they invest in a wide range of assets, for example, the ones that are given there, and they're actively managed. They're actively managed because of investing in different areas that are highly moving, highly mobile, then they have to be actively managed. So you find that even the way, whatever they charge as management fee and the rest will differ compared to money market, because somebody has to sit somewhere, make decisions with their money on where to invest. The other thing is that they have high potential, higher return potential, for example, between 17 to as much as 29%. So in Kenya at the moment, the major, and when I say the major, I mean by in terms of what you call AUM, assets under management, how much money they have, is Mansa X and Oak Special Fund. And these ones are managed by, basically, special funds are usually managed by what you call investment banks. So these are just companies that come together and they offer something that is able to give a higher return. And so I'll focus on these two: Mansa X, offered by SIB, and Oak Special Fund by Faida Investment Bank. But there are others that are coming up. If you read, you'll find them. So what I'm using here, I'm showing you what you call fact sheet. Fact sheet is just like a very short summary of what the fund is doing at what moment. So most of or by law, they are supposed to give you quarterly reports, just like the way we do our QA reports. They give you quarterly reports of how the fund was able to perform in terms of 3 months. So this is as per the last available Q3 report. So Q4 is yet to come out. Probably by the end of this January, we shall have it. So on the left, I'm having Mansa X. On the right, I'm having Oak Special Fund. And the things that you look at is, as I have highlighted in the blue arrows, showing both direction. And one is how much you need to invest. Remember, these are special funds. So most of the times you find that the amount of capital that you need to inject is usually more compared to maybe money market that tells you can even start with 100 shillings. So this one is more. And the assumption here is that maybe you have been having money in money market for 1 year now, and now you are looking at where else do I put my money since things are going down on the other side. So you find that a Mansa you need like 250K, the other side you need 500,000. But now the difference is in terms of how much you can top up. So each and every time you want to add money, how much you need to, the minimum that you need to add. Then you can see, as I told you, they will charge you higher because they are actively managed. So here, for example, Mansa will charge you 5%, while this other one charges you 6%. Prorated. Prorated means it is per annum. So if you joined, and the financial year starts from January to December. So if you join in month 5, which is May, it means they will calculate for you from the time you have joined. So that is what prorated means. But there are some other things that you need to be aware. For example, here, there's something I've circled here. There's what they are calling the hurdle rate. It means, and the hurdle rate they are giving is 25%. It means if they make returns that are above 25%, anything above 25%, they'll charge you a further 10% because they have made more than what maybe they had anticipated to make. And one thing is that nobody can guarantee you a return. Are we together? Nobody guarantees you a return. Let no one tell you, I am guaranteeing you a 10%. There is no guarantee in investment. Okay? Somebody can say, I'm aiming to at least hit a target of 10, but they can't guarantee. So if somebody comes and tells you, I'm guaranteeing you this kind of return, then just know that they are trying to mislead you and take away what you have. Then asset classes, this is where they invest. As I told you, these ones are diversified, and you find that most of the times, as opposed to money markets which have to do investments locally, these ones they can even do globally. Globally is whereby they buy, for example, stocks, Nvidia, Microsoft, and the rest. They even do fixed income and derivatives, precious metals. They buy even gold, currencies, commodities like oil, soybeans, and the rest. So they invest both locally, regionally within Africa, in other countries, and even locally. Locally is what for example, shares. They do equities. Equities and shares are the same. They do cash, fixed deposit, and the rest. And you can see in both cases they are almost similar. And then the other thing that you have to be very keen is about management. Who manages this company? So you'll have to have a trustee, you'll have to have a regulator who is a CMA, and you'll have to have somebody who keeps money for them. Okay, you can't be the same bank keeping your money for yourself. So somebody has to be holding that money for you. And then you have to have an auditor. And each and every year, you must be able to go through and see the audit report of that company. The other thing is that as per, again, going by the report, is how now they were able to allocate the money that they have. For example, if you look at Mansa X, they give you the Q3 top 10 holdings that they were able to have, and at the same time, Oak Fund also gives you, and they add up to about 100%. You can see most of the money they have invested is in what we call sovereign bonds. So these are Euro bonds, treasury bonds, and the rest. But there's some other, invested elsewhere. Whereas when you come here, they have what we call fixed income instruments. These are like fixed deposit and the rest. And offshore, like Nasdaq 100. These are what you call ETFs and the rest. But now, one of the things that I usually say is that you be keen, because as per this report, for example, my question was, all these add up to about 31%. So they don't mention, or they don't say where the rest, the almost 70% has been, invested in. And a fact sheet is supposed to give you that brief report. So I don't know. So those are some of the things you have to read in between. The other thing is about the performance. So this fund was started in 2019, whereas this one was started in 2024, February of 2024. So it means if you compare, for example, that period from 2024, when this started, and 2024, if you compare that period, then you can see how the performance was. This one was able to return an average return of about 5% per each quarter, per every 3 months, whereas this one had about 6%. But now if you compare, the whole year, which is 2024, you can see this one, before they removed all the taxes and everything that you have to pay the government and them, they had 24%. If they take out that, you get 19%, whereas this one were around 29% and the rest. But now you have to understand that this one just came to the market fresh, new, and everybody tends to run for something that is new. But the way the market performs is also influenced by people's behavior. This is just a projection of if you had invested 1 million in these two companies from the time they started. This is just a projection of how much you'll have as at September last year. So, for example, you can see this started in January 2019, and if you had invested 1 million within that period, then you'll have about 3.2 M. Whereas this one that started in February 2024, by last year September, you'll have had about 1.5 M. All right. Any question? Ama maswali ni baadaye. So that is just in brief. There are many others. This is just a simple way just to show you the differences and all that. Then when you go to the second one that I had mentioned is what we call the treasury bonds. So I think this one last time I had just mentioned briefly, but basically these are what we call debt securities or debt instruments, and these was offered by governments. For example, since we are talking about Kenya, we are talking about our country. So we have CBK, Central Bank of Kenya, as the person who issues these ones. And they're usually for funding public expenditures, and if there are deficits in what the government, the money they are looking for. And basically, you also have those ones that specifically are supposed to go for infrastructure projects. That's why you hear them being called IFB, infrastructure project bonds. And they are low risk. It doesn't mean they don't have risk, but they are low risk. And the reason is they are backed by the faith and credit of the Kenyan government. It means that it is in the interest of the government not to fail. So because of that, there is that faith that they are going to pay back once you loan money to them. And one thing that I also have to tell people is that as an investor, you should be able to separate, your feelings and investment. You might not like something, but as an investor, you have to look at it from that different point of investment. So they also have fixed returns, because what it means is that if the government tells you, I'm going to loan you money, you are going to loan the government money at 10% per annum for 10 years, it will be like that. There's no time it will come to 9% or go up to 15%. Even if the environment changes and things have gone up, maybe if you invest somewhere more, you get like 15%. Whatever you give the government at 10% remains at that. So that's what it means by fixed returns. This is also good because it is predictable. You can plan for it because at such a date, I'm going to get this amount of money. Then liquidity. It means each and every time, let's say each and every 6 months, there's money that will be coming in, and then at the end of that bond, upon maturity, you get back your money. Then it is very easy to access these bonds. By the way, nowadays, it has been made very, very easy. And the way you invest in this, you have to have what you call an account. And this account is called a CDS account. And you can directly open this through an app that is offered by CBK. It's called a DAO CSD. Then this one, once you have the CDS account, then you can participate in, the bonds that are available, whether treasury bonds or treasury bills. And then still, you can also access this in the secondary market. Secondary market means you can buy this in the Nairobi Securities Exchange if you missed what you call the primary market. Primary market is within the period when the government is offering that. For example, I'm just showing this one. This one here is one of the bonds that was on offer. That was actually, the auction date was today. I think around 2 or 3 p.m. So by now it has already happened. And today was the final day of bidding for this bond, these two bonds. And one, or when you look at a bond, it's called a bond prospectus. It just like give you information of what is a bond, how much is the interest, how much can you bid, when will it be paid, how, all that information. For example, this one is a bond that had been offered previously back in 2019, going for 20 years. And then this one was going for 25 years, offered back in 2022. By now, 13.2 years are remaining of this bond. So it means if you take this bond, you'll go with it for 13.2 years. Where this one you go for it with, you go with it for 21.8 years. And then you have what you call, this number is very important, the ISN number, International Securities something number, information number. So this one, each and every debt security is usually given this number. This means even somebody who is in abroad, US or wherever, they can also buy this bond because it has this unique number that identifies it. And these bonds can also be accessed by everyone. It's not just Kenyans. Even foreigners can access these bonds. You just need to have the right documentation. So if you bought into this bond, the government will give you back interest at 12.8%, and this one at 14.1%. But also, you'll also have to pay some tax. So if the way you pay tax, there are different types of tax. This one is usually called a withholding tax. If you are buying into any instrument that is 10 years and above, you pay 10% tax. If it is anything less than 10 years, you pay 15% withholding tax. For those who are in SACCOs, I think you pay 5%. And for those who are in shares and all that, you also pay 5%. So you also have to understand the kind of taxes that you need to pay for the different investments. It's not just for free. You'll have to consider that also. And you can't escape it. So wherever you go, it's there anyway. So basically, for most government securities, you need at least 50,000, unless otherwise indicated, for you to be able to invest. And you'll also have all this information. And one of the things I wanted to show is that you know when you're going to be paid. You know the exact date when you're going to be paid. For example, if you take any of these bonds, it means you'll be paid every April and every October. So after every 6 months. So that way you can even plan yourself, because you know that every April and every October I'll be getting some money back. And one of the good news, things are just becoming better and better, is that you can even pay using M-Pesa up to 250,000. If you bid and you're successful and you're told to pay for up to 250, you just need to use your M-Pesa and then you're able to pay that. Yes. Or competitive and non-competitive. So for anyone who is investing and you're investing less than 50 million, then you are called a competitive bidder. But if you are investing a minimum of 2 million, so nimesema the minimum you require to invest is 50K, okay? But if wewe minimum yako is, let's say your minimum is 2M, then you can opt to be a competitive bidder. So competitive bidder, the difference is that you are able to say to the government, yes, you have already fixed this at 12.8%, but maybe I would have wanted this at maybe 14%, or I would have wanted this at 15%. So you'll have your say. Okay, you'll have your say. But since it is already fixed, there is nothing, it doesn't make much difference. But it helps the government to know what the market wants. So this is the information that they use to even fix other interest rates that they give, for example, on the treasury bills or even other upcoming new bonds. So that is the difference. So it's in terms of how much money you are starting to bid with, and also you are able to at least say what you want, although it doesn't make a lot of difference. But always, if you have a lot of money, there are ways that you can always negotiate with somebody who wants money. You can even say, I want a higher percent, and you can have your way. Anyway, so why am I giving you this information about bonds? And one of the ways I like this is about something called a bond laddering. So this is just like a ladder. Think of about a ladder. And it's whereby you purchase different bonds that mature at different times of the year, meaning throughout the year you have some income or some money coming into your account. So this is just like a ladder. Imagine you have a ladder that have 12 steps. So each step representing a month. And the way you can do this, I've just used an example here. Let's say you have 12 million shillings. And you decide that these 12 million shillings, because they are 12 months in a year, and each bond pays twice, means it's per annum, but you're paid every 6 months. So you can divide this into 6 and have 6 bonds. Okay? Each bond allocated 2 million. So these 2 million you can substitute with whichever value that you have or the amount of money that you want to have. And then assume these bonds are paying these rates, these coupon rates. It means, therefore, this bond, for example, is going to pay 125,000 every 6 months, right? Then this one, like that, continuously like that. Then it means if you have this money spread out this way, in a year, you are looking at an income of 1.5, M. Okay? And then let's assume these bonds, these are their, their maturity. They are the years that they have to up to the end of those bonds. Then if you have this, then how do you use this information? For example, let's say you have school fees, you have some other requirements like life insurance, medical cover, investments. It means you can now spread this money to cover those things that you require each and every year. And if there is a time that, for example, this one is 2 years, it comes to maturity, it means then you can go back to the market and buy something else that replaces this bond. So this 2M, go back, Rudi Sokoni, look for something, that offers close to what you had or even better because they are there. So do you see how the practicality of this, okay? And always, remember we said when you are doing a diversification, you always keep looking for something that is offering better than what you have. All right. Now, to my final or to my third place whereby you can shift into is what we call shares. Others call them stocks. Others call them equities. So there are all those terminologies at the NSE. So I'm using NSE, Nairobi Securities Exchange, as an example. But you can do this elsewhere. You have Johannesburg, you have Namibia, you have Nigeria. So there are all these other different places that offer the same information that I'm giving here. So when you talk about shares, and when you say I have shares of this company, it means you own part of that company. And how companies make sure that or can have people own their part of their company is by selling part of their company to people. So if you have a share of a company, you're holding part of that company. And it means you'll be able to get what that company gets. If that company makes loss, you also make a loss. If they make a gain, you also gain. And one of the ways you can gain is through what we call dividends or capital appreciation. Dividends, because maybe you have been in SACCO or you've heard about SACCOs. So each and every end of the year, they say we are going to give a dividends of, let's say, 10 or 12%. So if you have X number of shares, you multiply by whatever they have said they are going to give you. And so you know how much money you're going to have. That's the same case. If you have 10 shares and the company says they're going to give 2 shillings per share as dividend, it means you have 2 times 100. So you're going to get 200 shillings as dividends. Capital appreciation or gains is whereby you bought a share when it was 5 shillings and after 1 year it is 15 shillings. So if you are to sell back that 1 share, it means you'll have gained 10 shillings on top of the what you initially bought it at. So that is a capital gain or appreciation. So in Kenya, we have what regulates that kind of buying and selling of companies that are listed. And we call it Nairobi Securities Exchange. And it is regulated. There has to be a prefect, somebody who is looking and seeing that you are following the rules as they should be. So this NSE are their partners. For example, you have what we call CDSC. These are the people who give you an account, and they're the people who make sure if you buy or sell your shares, they're able to transfer the shares to the person who has bought from the person who has sold them. So these are the ones that do that. CMA is the boss, the one that oversees everything. CBK are the ones who hold the money. And then you have what we call CASIB. These are an association of stockbrokers and investment banks. They are the ones who actually give you a platform to buy and sell shares. And this is just an example of the many counters. Counters just means those different companies that are listed. There are about 63 of them that are listed, but I think currently just about 58 or so, or 56 that are operating. So sometimes there are, company differences and all that. So a company is stopped from trading, for example, Mumias and the rest. But they are grouped into different areas. You have banking sector, you have the manufacturing sector, telecommunication, you only have Safaricom, agriculture, insurance, banking, energy, and the rest, okay? And anyone can participate or anyone can trade and can buy and sell shares in the NSE. And as of last year, 1st of August, it is now possible to buy even 1 share. Before it used to be a lot of 100, like the least you could buy was 100, but now you can even buy 1. For example, imagine, let's say, Equity Bank is right now at 67 shillings. So it means with the 67 bob, you can own 1 share of Equity. Or if you go to, let's say, Kapchorwa or even Kakuzi, which is at 440 bob, with 440 bob, you can own 1 share of Kakuzi, So that means there is no excuse. Even if you have 200 shillings, you can own like almost 8 shares of Cooperative Bank, which is at 25 shillings. Are we together? And remember, if you own them and you hold them, you'll be able to get dividends when they give out dividends at the end of either midway through the year and maybe at the end of the year. And there are all these good news that to make people participate more, the government has allowed Safaricom and Airtel to be able to allow you to buy and sell shares from your M-Pesa and Airtel money. So that is something that is coming up. They said by this end of this month, January. So that will make you even get closer, because people say shares ni wale watu wana pesa, ni wadosi. No, it's for everyone. And one of the things is that NSE is a 2 trillion market. Okay, it is worth about 2 trillion at the moment and even more. So this is, I know most people have talked about NSE shares, Nyoro and the rest, KPLC. I don't know how many shares I sold, I have now. So what is this all fuss about NSE? So what I'm showing here, I took from the NSE itself and from Frank Mwiti. So if you're into shares, you know who is Frank Mwiti. He's the boss of NSE. So all these companies, last year alone, they were able to give a return of what you are seeing here. So that means if you owned these companies at the beginning of the year and you held them until the end of the year and you sold, then you're able to make this amount of money, returns, that is. Okay? And then if you look at the different investment classes, you can see that if you had stocks on average, even the ones that were very low, the ones that were very high, you're able to get a return of 50%. So if you had invested $1 million, so you got $500,000 at the end of the day. Then there are what we call the special funds. They come second at 19%. You have treasury bonds at 13% and the rest. And then the list you have, if you have buildings you have rented somewhere, people are renting from you, then you made about 5.3%. The other thing you have to remember is about inflation. So inflation at the moment is about 4.5%. So if you made 5.3%, if you take away inflation, maybe you just made about point something as the returns. So those are things you have to always consider. But now, quickly, I want us to just have an example of capital gains and the rest. So if in 2024, because that's when the market started doing very well, if you had 1 million and you bought equity at 38 shillings, it means you're able to buy about 26,000 shares, or about 50K shares for KCB, or about 285,000 shares of KPLC, ile watu wameongea sana. So it means for equity, by last year, December, it was at around 65 bob. So you made about 27 per share. So if you sold all your shares, these ones, then you made about 730 above the 1 million. So if you did the same for KCB, you made this because the difference was about 42 shillings. And for KPLC, the difference was about 9 shillings. And if you sold, you made this amount. So that is the capital gains alone. So what about the dividends? So equity paid a dividends of 4.25 shillings. So if you take the number of shares you had, multiply by that, alone you're able to get about 111K out of the dividends. So cumulatively, if you take the dividends and the capital gains, then you get a return on investments of about 84%. And this goes on for the same case with KCB and KPLC. You see why KPLC had a lot of hype. It's because of things like this. What about, people always ask, na wewe umewekelea ama umeinvest huko. So I started, and this just, there are few shillings, 200, 1,000 here and there, but I just started. And when I started, I fell within when they were paying dividends. And the few that I had, some of them were even fewer than 100 shares, and you're able to get, the different. So yes, it is true, it's possible, and you get paid if you invest. Okay, so you can imagine these very few shares, whatever I had, that 1 million invested. All right, and there's more good news coming up is that what you call the blue chip companies. Blue chip companies, these are the big companies, Safaricom, Equity, KCB, those are the big giants in the market. There's even prospects of them increasing the dividends that they give back to the people who own their shares. So you can see, for example, if you have BAT, they pay 50 bob per share. You can imagine. One share, they give you a dividend of 50 shillings. So you can start doing calculations. You can see Equity, NCBA, Stanbic, which is, give you some good amount. And this is, I just took from, Twitter, that if you have any of these companies, these are some of the big giants in the NSE, and you invest like 10K in each of these companies, you can be assured by the end of the year, you are going to get some returns. So this is just an example. And this quickly, how do you trade, or how do you buy and sell in the NSE? So one, you have to have an account, and then you have to have a broker, because you yourself, you can't do it directly. You have to have a broker, and then you select the kind of company you want to invest in, and then you place the buy, and then after that, it is settled and then you'll have the shares of that company. It's very simple, ABC. And when you want to sell, it's the opposite of what you did when you're buying. Okay? Yeah. So where do I get this information? There are so many places. This is just a few of the places you have to follow, or you have to listen to what CBK is doing on saying. There's Business Daily. You can even subscribe and pay to be reading that newspaper. Very important. That is where you get information on who is selling, who is buying, which company is being sold, which company is being bought, which company is being sued, so that you know when to buy or sell their shares. Then you have NSE itself. You have all these other different players that give very useful information. And there's an upcoming app on Safaricom, M-Pesa, called ZED Trader that will allow you to be buying and selling shares directly without even thinking about a broker, because as it is at the moment, you have to have a broker. Okay? But most importantly, you have to read, you watch, listen for information about business news. Kitambo, I know, ikifika business news, una switch station. If you want to invest and become an investor, that is actually the most important news, not the sijui mwanasiasa alisema nini. So take away tips quickly. There is never a right time or enough money to start investing. That will never come. If you wait for that time, it will never come. And it's not about how much you earn. It is how much you're able to invest. You can earn 1 million, but you're not able to invest anything. So you and the person who is earning 20,000 and they're able to invest 2,000, we are 20K yako mbele yako by very far. So it's not how much you earn, it is how much you're able to invest. And then investing isikuwe ati ni by the way, ati kile kinabaki ndio na invest. No. You see the way you pay rent, let investment be part of, just like rent, that 5,000 for example is for investment, and it becomes part of the requirements or the necessity that you have to have each and every month. And then you must be realistic. Okay? You must know why you're investing. Have a goal. Have a direction where you want to invest. Otherwise, you just be lost. Don't invest because other people are investing. Know why you're investing. Then the other thing is that you have to be consistent. You don't just do it month 1, month 2, then that's it. Remember, if you want to create, even those who people say generational wealth, if you follow or if you listen, they had to do it consistently over a long time. That is the only way you can realize wealth, unless you are doing other things. But if you are just doing it the way it should be, then it needs to be consistent, and you have to be, do it over a long time. Then you have to diversify, as you have said, so that if one investment goes down, the other one improves, then it is able to pull the one that went down, so that you don't realize the losses from this other one. And then you have to do it with confidence. And how do you get confidence when you're investing? You have to do your homework. You have to read. You have to find information. You have to ask questions. Even if someone tells you invest, ask questions. So ask them, where are you investing my money? So how much are you taking so that you can give me whatever you're giving me? How can I access my money? So if, for example, somebody has a very poor, communication, and they are whatever HR or whatever, they are very poor in communicating, that is not a very nice person to invest with. What if you need your money very fast? Where do you get them? Where are those people? Where can you get them? Okay? And then you avoid what you call FOMO, fear of missing out. Just, for example, KPLC was doing very good, so everybody went for KPLC. That is also a marketing strategy. If I have very many shares of KPLC, I can make a lot of noise so that the interest goes up. If the interest goes up, then the price also goes up. So the one who has a lot of shares, then they sell to you people who want to buy now because the interest has gone up. That's how they make money. So even if people are talking about it, find out first. Why are they talking about it? Read about that company. What are their fundamentals? Do they have losses? Do they have loans they are paying? Do they pay their loans? Do they actually have money? For example, right now you see Uchumi. Right now people are talking about Uchumi and the rest. Uchumi has been making losses, for example, but last year they made 8 million profit. And then all of a sudden, people started getting interested. But if you look at Uchumi, their fundamentals, they are very poor. So compared to, let's say, a company like Safaricom or even Equity. So first of all, understand how the company is performing before you decide to go into that company. Then I'll leave you with this, that between knowledge and outcome, there in between is your decision and the time you take to make that decision. That is what determines the outcome. So if you take very long, remember we said investment is all about time, money and time. If you take very long to make a decision, then it means it delays your outcome of financial freedom. So with that, thank you.
We are on the top of the hour. I think if you can look at your watches, you're gone. So any question, burning question? Yes.